So let's look at liquidity. And one thing you'll know for liquidity, how are we able to meet our current debts, not our long-term debt, but our current debts? How are we able to make those payments? And if you see here, there's nothing that lists liquidity, because sometimes things are listed just in different ways. So on this particular site, it's under cash and debt, is a way to kind of find it, our current cash and our long-term debt. So you'll find that information under here. But if you're looking for liquidity in this site, you won't find it there. So if you're looking at other sites, be aware that your information might be hidden, or maybe not hidden, but just in a different spot. So we're looking for the current ratio and the quick ratio. How good are we at paying our current bills? And they're both at the bottom here on this particular site. Current ratio for Coke, 1.2 versus 1.4. Once again, you want these numbers to be greater than 1.0, that you're making your debts. And the quick ratio, or acid test ratio, is a tougher number than the current ratio, as we learned. So, that number should be lower than the quick ratio because of how it's calculated. And once again, if you're at a 1.0 or better on a quick ratio, that's really good. That means you're really, you're making your payments, so you seem like a very liquid company. You're not in trouble. If you're greater than 1.0, if you're way lower than 1.0, then that might be a little concerning. Well, more than a little concerning. Next, we want to look for debt, and we also find that under the cash under this cash and debt area, and we're looking for debt to equity, and we're looking for interest coverage ratio. So debt to equity, you can see that right here under total debt equity. You can see a trailing 12 months debt to equity, or a most recent quarter debt to equity as well. So you can see they're pretty similar. But you can see their debt to equity. So they have pretty good sized numbers as far as debt to equity. Lower the number, the better as far as your debt relative to your equity. And then lastly, we were looking for inventory. Why do I keep saying inventory? Interest coverage, our interest coverage ratio, and that's right here above the current ratio and quick ratio on the bottom under debt ratios. And you can see our interest coverage is right here as far as our interest coverage ratio, and you want that to be greater than 1.0, and they're both knocking that out of the park, so we're not worried about making our current interest. Anything could change at any moment, but right now it looks pretty good. All right, and then lastly, we're looking at our efficiency ratios as far as that category, looking at how fast are we turning over things, and there isn't really an efficiency thing in here. Sometimes it might call management efficiency or something, or it might be hidden in another area. So in efficiency ratios, we're looking at asset turnover and inventory turnover. What we knew under profitability was that inventory turnover ratio towards the bottom here. So that's our inventory turnover ratio that we'll capture. And the one thing that's the one downside on this side is no site's perfect, and this one doesn't happen to capture asset turnover. So if you really want to dig in deep and get into asset turnover, you can look at return on assets, which is a good number to look at if you're looking at assets. So once again, that's found under the profitability, the return on assets. Let's go down here. You can see return on equity, return on assets. But if you wanted to look up asset turnover, not on this site, I happen to look it up on their individual websites and things for Coke and Pepsi. You could also find it in some other places too as well, as far as asset turnover. So it's not listed on this site, but you can always get that right again from the companies themselves if you want to do your due diligence and get to every type of ratio. Other return on asset can be very helpful as well. So the nice thing about this site from Fidelity, once again, look at if you have your own sites that might be like you're hooked up with a particular online broker or something like that. They have some pretty robust sites, but this is free, and see how we were able to easily get all the information. So we got all the information. Now I have a spreadsheet here so we can kind of compare, well, how they end up doing. How do we compare at this moment in time? And there's a lot more ratios. There's a lot more qualitative information out there too, but right now in this moment of time, how do they compare? And basically I've got Coke and I got Pepsi here, and if it's highlighted in yellow, that means that they are better than the other company. Doesn't mean that's necessarily great overall, but they're certainly better than the other company. So if you look at, let's say, this PEG ratio here, 8.07, 4.18, we would like actually something that's below 1.0 generally is better in a PEG ratio. Particularly if you're a value investor and you're looking for those contrarian stocks, those stocks that are on sale, or something like that, you might look at these and say, well, their price relative to their future earnings growth, which is what a PEG ratio is looking at, as we learned. You're not seeing something that's really undervalued here. Doesn't mean it's not a good stock, not a good dividend paying stock or anything of that nature, but if you're searching for low PEG ratio below 1.0 stocks, you probably would pass up these two stocks. Even though Pepsi has a lower number and might say, yeah, its price relative to its future earnings growth, you're getting a good price in comparison to Coke, is how you'd look at that. Once again, for any of these ratios, review the lessons on the individual ratio to learn more about them in great detail if you happen to skip ahead to this one, or this is just kind of the summary and where to find all the information. So if we look at it, we can see, Pepsi has got a good price to earnings. Once again, how it compares to the market, industry, all that could be different, but comparison to Coke, just slightly better than Coke. PEG's a little better. Price to sales, it's got a lower price compared to its its sales. Coke's got some good book value there, so that's a good price to book. So you're getting a lot of good company for your price you're paying. Better dividend yield and better dividend payout. They both are consistent growth payouts, but they're better dividend yield and dividend payout between those two. Let me go back to them because I put it in, I think, a wrong number there. Let me just double check that on that dividend payout. 80.46. So I'm looking at dividend payout. Oh, I was looking at the last quarter. So the last quarter they paid at 43 and 51, which is a good sign for the last quarter. But if you look at the trailing 12 months, they're at 80.46 and 85.03. So that's the thing with ratios. You got to kind of look at what you're looking at there. So if I'm looking at last quarter and most recent data, I'd say, boy, they're doing great. Under 70%, pretty good. But over the last 12 months, they're a little high. They're in the 80s. So maybe that would be concerning. You need to kind of figure out, well, how's it look maybe going forward? Profitability, they got good margins. Pepsi runs a real high margin. That's our nice high return equity, a nice return assets for Coke. I meant to say that Coke runs a real nice high margin in comparison to Pepsi. So if I'm looking at Coke, I'm thinking good dividends, good dividend payout, at least over the last quarter, good profit margins. So when they're making sales, they're making more money that can help pay those margins. Liquidity, they're both above 1.0 with these liquidity ratios, so no worries there with either one. Pepsi's a little better. Debt, the lower the better, and certainly interest coverage ratio, you want that to be greater than 1.0. So you can see that, Coke's got a nice balance sheet around debt to maintain that debt. And then efficiency, we looked up that asset turn off site on their annual reports and different information on their website because it wasn't in the Fidelity site, but the 0.13, 0.12, they're right there. And then inventory turn, Pepsi has a nice inventory turn. So if you're concerned about slowing sales or concerned about, turn on inventory, that's where Pepsi maybe stands out a little bit better. So what does all this mean? If I was to look at this right now, I would say there's no clear-cut winner. There's some things I like about one versus another. I like this dividend payout for the last quarter, and I like that I get a nice yield, but maybe Pepsi's a little bit more on sale. I mean, actually lower the number is better, so that should be Coke here on a price to earnings 22.1. But they're so similar. It's almost a push there as far as Coke and Pepsi. But nice profit margins from Coke. Both are pretty good. Nice inventory turn from Pepsi, but nobody's standing out as a clear-cut winner. And if I'm looking for something that maybe is again a low value or undervalued stock, looking at that PEG ratio, I'm not seeing undervalued stock here. I see pretty good valued stocks relative to their future growth. Their earnings growth is how companies are evaluated as far as paying out things like dividends, or how they're evaluated from their potential earnings per share and their price to their earnings. Having earnings growth is really important for that. So Coke and Pepsi, good. And so where they typically fit, they're big companies, large cap, dividend payers, long-time dividend payers, good, solid Fortune 100 companies that are going to consistently pay you kind of a solid dividend. But if you're looking for something that's undervalued, or you're looking for that high growth stock that might have a real high price earnings because you're expecting it to be the next Google or something, then these wouldn't be the companies for you. One last thing here on this as well, we go back to our original kind of evaluation thing under the key statistics here, and you can kind of see their week over the last 52 weeks in this particular snapshot. Pepsi's done a little better over the last 52 weeks, 13% versus 7.64. You can compare that to the market and all that kind of stuff. But if you look here under sector and industry, you can see they're both in consumer staples, like consumer type goods is another way to think of that, staple, type goods. And they're both in the beverages category. They're not in retail, they're not in grocery, they're beverage manufacturers. They make beverages. So you would find them in the beverage category. So this means it's a fair comparison. Now it's easier with Coke and Pepsi because they're pretty national, international, known brands. So it's easy to know they're maybe in the beverage sector. But if you take another company that might be a smaller cap company or a newer company, you might not be as sure where do they fall in. Are they in the beverage sector, or are they in this another sector or something of that nature? Okay, so the whole upshot of all this is you can use this as a nice tool to get your ratios quickly.